It has been a very, shall we say, volatile year in 2019 for the Fed. What do you think you've learned about the economy over the past 12 months?
While there's been a lot of volatility, we actually haven't ended up much different than what we expected last March. So if you look at where our forecast was for the end of the year, we thought that we'd get growth around 2%, a little bit above. We thought we'd have the inflation rate at 2% or a little bit below, and an unemployment rate in around 3.6%. And that's pretty much where we've ended up. So despite the tariffs and the volatility that's occurred in some of the financial market movements, we actually haven't ended up in a very bad place. So we're pretty close to our inflation target. Core PCE is just a little bit off of where we'd like it to be. It's at 1.7. We want it to be at 2%. The unemployment rate's still quite low. By historical standards, it's really quite low. And GDP is growing roughly at what we would expect, which is around potential. So in terms of economic data, the outcome's been quite good.
Well, Chairman Powell said last week the economy is in a good place. Would you agree with that characterization?
I would. I think we are in a good place. Now, the composition's been a little different than we expected. We expected business fixed investment and exports to be a little bit stronger. We didn't expect consumption to be quite so strong. So the imposition of the tariffs, the global slowdown resulted in both exports and business fixed investment being weaker than we would have forecast. Consumption, though, has picked up and been quite strong, and we expect it to continue.
Would you think it would have been that way without the Fed's rate cuts? You dissented on all three of them.
So we would have been a little softer in some areas. So residential investment looks like it's picking up. But one of the challenges, I think, is thinking about what the side effects are of very low interest rates. And there are two side effects that I am particularly continuing to worry about. One is how much room we have if we actually do get an actual slowdown as opposed to a concern about a slowdown. And in that case, we don't have that much room before short-term interest rates would hit zero. The second concern is that right now the stock market's been doing quite well. Other financial markets in some areas have been quite ebullient. And the question is this the stage of the cycle that you want to have a little more push to financial markets? And I would argue I'm not so certain that that's necessary.
Well, you made a major point of both of those in a speech last week in Oslo. Let me ask you about the first. You're basically saying the Fed's almost out of ammunition.
I'm saying we don't have as much room as we had before. So prior to the last three easings, the Fed funds rate was pretty close to what I would expect to be as neutral over the longer run. We were at 2.4%. Since then, when we've reduced the federal funds rate by 75 basis points, given the level that we were at, that was a substantial amount of easing. So both monetary policy and fiscal policy are accommodative right now. And so I'm not so sure we needed quite so much accommodation at this time. So I am a little bit worried that we have less room than we otherwise would have if we were to have a big negative shock. And I would say it's not just the short end of the market, so the long end of the market, it's been fluctuating between 1.5% and 2%. That's a lot lower than what we were experiencing prior to the last recession, which means even quantitative easing will have some limited effect, given that that could quite easily get down to zero more quickly than we're expecting.
So then what do we do?
I think we'll need fiscal policy at that stage, and fiscal policy in a very low interest rate environment, fiscal policy becomes a much more important tool. And in the talk that I just gave, it also highlighted this is a time where we should be thinking about buffers, including buffers for capital ratios for banks. And in general, fiscal policy, you'd like to have a little bit more of a buffer. State and local government, you'd want to have enough buffer that they can weather the storm and hopefully not have to cut back if we were to have a recession.
Yeah, but you take a look at what's happening in Washington these days. There's no guarantee you're going to get any fiscal policy. So what would happen then?
We'd have a longer recession than we would prefer.
And can the Fed do anything in that case except cut rates to zero and do QE and then just cross your fingers and hope?
Well, first of all, when we ease policy, it takes some time to have an effect. So lower interest rates have an impact over a number of quarters. So we would have some flexibility to lower rates both at the short and long end of the market. That's the primary way that monetary policy works. So I'm sure if it looked like we had a severe recession, we'd get creative about other things that we could do. I would hope that we don't have to do that, though.
Now, you talked about the markets and the time in a cycle in which mistakes are made. Are you particularly concerned about that now?
I'm not particularly concerned about that. Obviously, in a period of a global slowdown, It's an unfortunate time to be having some of the tariff disputes that we're having. It would be nice if that got settled more quickly. But I'm not expecting necessarily to have a particularly large shock anytime soon. In fact, my forecast is actually for much of what we've seen over this last year, which is growth around potential, pretty tight labor markets, and inflation around our inflation target.
What does around our inflation target mean? I mean, we have struggled to get to the Fed's 2% target. Do you think that we can get there, and if so, how?
So labor markets are tight. Wages have been going up. I'm a pretty patient person. I'd be willing to wait a little bit longer for those tight labor markets to have an impact on prices. I don't think there's a big cost to being a little bit below 2%. I'd rather be higher, but I wouldn't want to distort financial markets in order to get that outcome. So I think we're looking at Japan and Europe, where they've actually pushed their rates very, very low in order to meet their inflation target. In fact, it's been negative in places like Germany and Japan. I'm not sure that's a constructive policy, and in fact, I think we should think about how much we want to distort financial markets to hit inflation targets. If we're pretty close to 2%, I would like it to be above 2% right now, but I wouldn't really distort financial markets to get that outcome.
Well, there are a couple of proposals in the Fed's monetary policy review. One is average inflation targeting, where you let it run above 2% if you can get there. The other would be to do a range instead of a point target. Would you favor either one of those?
My own personal preference, and this is still a matter of discussion, but my personal preference would be a range. I think a 1.5% to 2.5% target, where during good times you aim for the higher part of that range, and knowing that when you have economic downturns, you're likely to be a little below that range. That's how you end up with a symmetric 2% inflation target. So I actually am in favor of having something more like a range, where we're aiming for 2% over time, but we're in a 1.5% to 2.5% target range.
I wasn't going to necessarily ask you about President Trump, but he did meet with Jay Powell today. Cordial conversation, they say. And they suggested that they did talk about negative interest rates, which is a big thing for the president. You say you don't like them. Do you like them? Do you not like them in general, or just for the United States?
I actually don't like them particularly in general, and particularly for the United States, in part because our financial markets are a little bit different than European financial markets or Japanese financial markets. I don't think it's had the desired stimulus to get the long-term yield so negative in some parts of the world, and it starts to get distortive behavior that I don't think is helpful. In the United States, we have some very vibrant short-term money markets, and I think it would be pretty disruptive if we went to negative rates. So I think it's a policy that some countries have tried. It's not clear. Those countries are still not getting their inflation target. In fact, they're further away than we are after being negative for some time. So I don't think that so far, at least, we've seen much of a success. And I think particularly in Europe, they're beginning to reevaluate whether the negative interest rates have been as helpful as they thought.
We're talking with Boston Fed President Eric Rosengren here on Bloomberg Television and Radio Worldwide. To follow up on that, banks argue certainly against negative rates and say it distorts their financial incentives. In your speech, you suggested that you are concerned about banks' excessive risk-taking and levels of capital. We've been reassured many times by Fed officials that the banking system is in much better shape than 2008. So how would you describe it?
So one of the points of my talk is, in an environment where the federal funds rate is 4% and the long-term treasury rate's above that, you have a lot of room before you hit zero in an economic downturn. Should you have the exact same capital buffer in a world where your federal funds rate is closer to 1.6, and so is your long-term 10-year treasury rate? So we do care about how much room we have, and monetary policy has been the primary way that we've gotten out of recessions in the post-war period. So if we're in an environment where interest rates are much lower and monetary policy may not be able to provide as much stimulus, that's an environment where other buffers have to be larger, including capital buffers. So while I do think that we have substantially increased our capital buffers, if you really think we're in a low interest rate environment, I think if you thought we were in the right place 5 years ago, we probably aren't in the right place now that we think that interest rates will be a lot lower.
Should we have a counter-cyclical capital buffer?
I definitely think it would be appropriate to have a counter-cyclical capital buffer. The entire idea is that you'll have a bigger buffer right now when financial markets are doing quite well, And in the economic downturn, you would reduce the capital ratio so that you didn't have to shrink bank assets. So banks are an incredibly important part of how monetary policy is transmitted. If you're in an environment where banks are trying to shrink, it's very hard to have the same amount of stimulus as an environment where banks aren't constrained. So I think the countercyclical capital buffer is one of the ways to avoid that problem.
Can't let you go without asking a question for our short end friends, and that is Jay Powell last week said he thinks the Fed has the repo problem under control. Do you agree?
I think in general it's under control. It certainly will be under control after we continue to do all the Treasury bill purchases that we've announced. So I think between now and spring we'll be expanding our balance sheet, and that should be more than sufficient to solve, I think, a lot of the difficulties that were experienced in September.
Do you have a number for how big you think the excess reserve should be?
I think by the time that we get to spring, we'll probably have enough excess reserves that it'll become much less of an issue.